Well, I think that the reason that the market continues to do well is several-fold. First off, it's usually a credit crisis, something where maybe the Fed is raising interest rates that causes the market to go into a tailspin. But the expectation is for the Fed to keep interest rates at the short end very, very low. And as a result, what we're seeing is a steepening of the yield curve, and that usually is supportive of stocks. So the thought is that yes, we will end up getting a correction. We just don't know when. We have a market weight recommendation on technology and communication services. Back in the third quarter of 2020, the growth stocks were outperforming the value stocks by 35 percentage points on a rolling 12-month basis, which was the highest in history going back to the mid 1970s when these indices were created. So I still feel that there is some unwinding that needs to take place. I don't think that you necessarily should be selling the growth stocks that you already own. I just think it's a little bit early to start loading up on them just yet. Supply is not terribly short, and also with the canceling of the pipeline that was under construction, no oil was flowing through it. So we're not seeing a restriction in supply there either. I think that the reason that oil prices have been heading higher is because investors believe that the global economy is emerging, and as a result, we'll see a pickup in demand for energy, and that would put upward pressure on prices. Going back to 1953 and looking at the yield curve, meaning the 10-year yield minus the 1-year yield, what I find is that in those months in which we see an increase in that yield curve, that the sectors of energy, financials, materials are the three best performers. And so energy possibly could continue to take a leadership role. We're already seeing energy do well. The problem is that energy was coming off of such a low base that really it's just beginning to climb out of the bottom. And so it really has a long way to go to the upside. Actually, because of the recovery in energy, the 10 worst performing sub-industries, 5 of which included energy at the end of last year, are now doing very well, up about 3 times that of what the market is doing. The banking area should do relatively well, especially if they have a lot of interest income, because traditionally they borrow money at the rate that they offer to checking and savings accounts, but then they lend it at a much higher rate. So typically the profit margin is the yield curve. And as that yield curve steepens, then it increases the profit margin for the banks. I think that the problem is that of the 2 emotions that drive stock prices, fear and greed, fear is a much greater motivator because adrenaline enhances memory retention. And that's why the media tends to adhere to the old adage of if it bleeds, it leads. So investors are constantly worrying about, oh my gosh, well, what's going to happen next? When do we get the next pullback? When do we get the next correction or even the next bear market? Unfortunately, by the time the market does go through such a decline, it's probably that much higher than when investors started worrying about it. So the amount by which the market does sell off is probably less than where they would have gotten in. So investors need to remind themselves that 82% of all months since World War II have been in bull market mode. So more times than not, the market is likely to be heading higher. Also, more important, I believe, is the speed with which the market recovers from declines. Pullbacks are 5 to 10% decline. Historically, it's taken a month and a half to get back to break even from such declines. For corrections, which are 10 to 20% declines, the average time for full recovery is only 4 months. So I like to tell investors you are better off buying than you are bailing.